the prevailing stability in the foreign exchange market would continue to moderate pressures on the domestic price levels. The MPC noted the improvements in the financial stability indicators, including non-performing loans, capital adequacy, and liquidity ratios of the deposit money banks. It urged the bank to sustain its surveillance over the banking system by taking prompt corrective measures to further improve stability in the system. The committee also called on the fiscal authorities to build significant buffers to strengthen the efficacy of monetary policy. Overall, the Monetary Policy Committee considered the options of either to loosen, hold, or to tighten. The committee continues to hold the view that although loosening would encourage the flow of credit to the real sector, help in reduction of the aggregate cost of credit, and spur business spending and investment, thereby reinforcing the CBN's support for output growth and economic recovery, it, however, believes that doing so would reverse more rapidly the gains of price and exchange rate stability achieved so far, given the liquidity impact that would entail. The ensuing liquidity will exert pressure on the exchange rate in the light of increased capital flow reversals arising from monetary policy normalization by the US Fed. This will further depress the capital market. As for tightening, the MPC holds the view that while tightening will strengthen the stability of the foreign exchange market because of its dampening effect on the demand for foreign exchange, it was, however, convinced that this would simultaneously dampen investment growth, widen the output gap, depress aggregate demand, and weaken output growth. It recognizes the fact that it had held the policy rate and other policy parameters constant over the last several meetings. Committee underscores that by holding its policy positions constant over this period, it has confidence in the various policies and administrative measures deployed by the bank, which have resulted in the moderation in domestic price levels and stability in the foreign exchange rate. Thus, a hold position is an expression of confidence in the policy regime, given the gradual improvement in both output growth and price stability. On this premise, the downward risks to growth and upside risks to inflation appears contained. Committee's decision. In the light of the above, the MPC decided by a vote of all 11 members present to hold. In summary, the MPC voted 1, to retain MPR at 14%, 2, retain the asymmetric corridor at plus 200 and minus 500 basis points around the MPR, 3, retain the CRR at 22.5%, and 4, retain liquidity ratio at 30%. I thank you for listening.